We've all seen the articles that say gold is going up or down, usually accompanied by some data, some prognostication, occasionally a statistical analysis. The forecasts can vary. We've seen anything from $2,300 to $10,000 per ounce gold. Now, how often are these forecasts right or wrong, and should we pay attention to them? Before we begin, please like and subscribe to keep the channel going strong. Thank you. Well, to start, let's look at the track record for the current year. It's September, and some common forecasts for end of the year range from $2,300 to $3,000 an ounce gold. We still have a few months left, and gold prices can move very quickly, so it's possible that we'll see some upward movement if gold breaks past its historical high. If gold hits $2,100 this year, for example, that might provide some momentum for further gains. But let's be realistic. From the time of preparing this video, gold hitting $2,300 an ounce would represent a 17.5% increase in a matter of a few months while setting new all-time highs. So how likely is that? Well, if we look at the average price of gold and the change in each quarter, we can somewhat calculate the likelihood of achieving a 17% or greater improvement in gold prices between now and the end of the year. If we look at the last 180 quarters, stretching back to 1978, we see that gold prices increased by more than 17% quarter over quarter, just 5 times. So it's not impossible that we'll see $2,300 an ounce gold in 2023, but the odds are long. And indeed, many analysts have adjusted their forecasts the closer we get to the end of the year, often maintaining price targets while moving the dates back. Now, there are some flaws with that methodology I just shared, but it's suitable for our purposes today. Forecasting is hard. Even the best statistical analysis will be wrong. In 1976, the famous British statistician, say that 5 times fast, George Box said, "All models are wrong, some are useful." Statistical models always fall short of reality because they can't accommodate the complex and numerous variables in the real world. However, we can still glean some useful information from them. For example, Goldman Sachs predicted that gold would rise to $2,300 in 2020, and Bank of America thought gold would hit $3,000 within 18 months of their 2020 prediction. Goldman stuck to their price target in 2021 and actually revised it upward in 2022 to $2,500. Forbes published statements from commodity strategists at global banks that predicted gold to $3,000 an ounce in 2023 to 2024 timeframe. Multiple investment firms have come in even higher with their predictions, some to $4,000 an ounce. The LBMA has actually stuck the landing and was very close to the average price in both 2021 and 2022. So if most of these forecasts have been inaccurate, what can we learn from them? Well, the most interesting thing is that almost none of the models or pundits are predicting gold prices falling. So we're seeing a lot of positive indicators from these models and the industry analysts building them. It means a lot of professionals are expecting long-term gold price growth and new all-time highs. But we shouldn't trust these forecasts are going to materialize when they say they will. And we should expect prices to rise and fall as they naturally do. Prices may retrace their steps before climbing higher. Forecasting is notoriously difficult for something like gold prices because of all the unpredictable elements affecting gold. Interest rate hikes, the US dollar strengthening or weakening, inflation, geopolitics, war, and crisis all affect gold buying. Technology is changing and can be influential in the most surprising of ways, such as how technology enabled globalization. So, what's an investor to do? And the best approach for most investments is to avoid trying to time the market. This is something that's repeated in every market by just about every financial advisor out there. And we all hear the stories about someone who got it just right and scored big. But the world is littered with tragic stories of loss as well. An investor who's trying to build a portfolio with reduced risk and ensure long-term wealth might be better served by focusing on creating a balanced portfolio with incremental purchases made over time until their goals have been met. With this strategy, the forecasts for gold prices are largely irrelevant. You simply buy what you can afford over time and calmly continue to increase your holdings. Set a plan for your long-term wealth vision, ignore the noise, and carry on. The strategy is also called dollar cost averaging, and is the process of systematically buying investments over time at regular intervals with equal amounts of money regardless of price. The math checks out that this generally produces less risk, lower average costs, and more reliable returns, all without the need to actively manage investments or stress about market movements. That's all we have for you today. Please remember to like, subscribe, and share with a friend. Thanks for watching, and we'll see you next time.